Hello to everyone. Today I am here with Introduction to Corporate Finance, Financial Planning and Growth, Part 5. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this section, we are going to cover the concept of financial projections, capital expenditure requirement, capital applied strategy, and plug and sensitive analysis. The ingredient of financial planning model include first of all the projections, financial projection. The first step is to develop the projected monthly cash flows that include, first of all, inflow from the operation. Inflows are from operations that directly include the direct revenue or the sales. If you are a service concern, so you have the direct revenues. And on the other side, if you are production concerned, you will have the sales. Revenue and sales are of two types. One is cash sale and other one is credit sale. In a similar way, you have on one side cash revenue or credit revenues. Normally, within the organization, there is a mix of cash and credit, revenue or sale. And all revenues are net of taxes. So, when we discuss about the revenue or the sale, the figure comes that is net of the taxes like sales tax, not the income tax. Because income tax is calculated after EBT, earning before interest and tax. So other thing comes outflow from the operations that include the all type of the expenditures like salaries and wages, maintenance. On the other side, you have utility bills, etc. Inflow from non-operation include all type of the borrowings and debt instruments. Borrowings are usually from the financial institution, from family and friends, from subordinate companies, from directors, etc. On the other side, you float the debt instruments like bonds, term finance certificate. Other revenue from non-operations comes the disposal of assets. And the first one is the owner's equity that I have mentioned in the last slide. Outflow from non-operations include capital expenditures requirement, debt payments, owner's withdrawal. Owner's withdrawals are usually again a dividend payments. Now, how we are going to calculate the net cash flows? It is calculated as inflow from operations minus outflow from operations. Thereafter, plus inflow from non-operations minus outflow from non-operations. That is equal to net cash flow. Based on the net cash flow, the financial provide the minimum cash need and the short-term deficit. If the net cash flows are negative, it means you have to meet the deficit, short-term deficit through any type of a short-term financing. And on the other side, you are able to assess the cash need for the business. That cash need is also met. If net cash flows are negative, that cash need is also met through short-term financing. Thereafter, we'll calculate the initial cash outlay at year zero. All type of the finances inducted within the business till the business comes in operation. If your company is a manufacturing concern and being manufacturing concern company, it may take 5 years to come in operation. The moment you have run your trial run against the product and product comes as per your standard, thereafter you become an operational company. Until that date, all the expenditure is considered to be a part of year zero and is called initial cash outlay. Subsequently, net cash flows usually develop from 5 to 10 years. On the basis of those cash flows which you have developed from 5 to 10 years, you apply the capital budgeting technique in order to assess the viability of the business, particularly payback period, net present value, IRR, internal rate of return. These variables is considered to be the basis for in order to take the decision for the project. Analysts also go for the in-depth further analysis as well. Financial projection based on the calculation calculated from projected cash flow develop the projected income statement, balance sheet, and cash flows. The cash flows are of three types: cash flow from operations, cash flow from investing, cash flow from financing. Capital expenditure requirement, although the cash outlay, the outflows from non-operations include all the detail of all type of tangible and intangible asset requirement. Based on the production capacity and the consumption, the working capital or the running finance deficit may also be evaluated as a part of net cash flow deficit. If the net cash flows are negative, it means you are in deficit. If the net cash flows are positive, it means you have surplus funds to meet your business requirement. Capital employed strategy. Capital employed is the sum of capital equity and capital debt. And normally companies develop a mix of capital equity and capital debt. There are very few companies which are called 100% equity based company. Means there is no debt injected within the company. So capital employed is the financial mix of capital equity and capital debt proportion policy should be adopted by the organization, keeping in view the strategy related to dividend payment and the capital expenditure. On one side, the company develop a policy. For example, the company says that our minimum equity will not be less than 40% of the capital employed. It means your capital debt cannot be more than 60% of the capital applied. And in a similar way, you also develop a policy that, for example, 50% of the profit, net profit earned by the company will be paid to the shareholder, that dividend. On the other side, if you have any plan for the business extension, like you want to build a new block after 5 years, you may change your dividend payment policy. You may decide that 20% will be paid as dividend payment to shareholders. 40% will be kept as reserve for the reserve for the building block, and the remaining 40% will be reinvested within the business as retained earnings. So it varies according to your policy and according to your strategy. Plus, compatibility across the various growth targets will usually require adjustment in a third variable. Now, cross various growth targets. Suppose a financial planner assume that the sales cost and the net income will raise at G1. G1 can be 10%. Further, suppose that the planner desired asset and the liability to grow at a different rate. It may be 15%. These two rates may be incompatible unless a third variable is adjusted. For example, compatibility may only be reached is outstanding stock growth as a third variable. It means with the growth of income and the cost. On the other side, asset and liabilities growth. Definitely, the value of share in market will also grow. If the growth is negative, share price will decrease. If the two growths are positive, share price may also behave in a similar way. Sensitive analysis, the sensitive analysis are projected keeping in view the conservative approach by applicating economic scenario over the life of the plan. Interest rate forecasts are part of the plan as well. In any type of a business, the economic condition having the direct impact on the interest rates and exchange rate. If your currency is a soft currency, even in case of a hard currency, it may convert into a semi-soft or soft currency. Depending on the position or the health of the country in order to bear the economic shocks. We have multiple crises that affect all the countries within the globe. Recent COVID-19 crisis, in the past 2007-2008 crisis. So there are few countries who may not have the shock. Otherwise, globally, most of the countries are affected with those economic shocks. Thank you very much. See you again with the upcoming video on the similar topic very soon.